Right, so we've looked at prepayments, prepaid expenses, and unearned revenue. And we said this was when cash changed hands before the expense was incurred or the revenue earned. Now we'll take a look at accruals, so accrued expenses and revenue. And in this case, we get cash after the expenses are incurred or the revenues earned. Accruals in general are the recording of the expense or revenue before the related cash is paid or received. So we are earning or incurring these amounts, but no cash has changed hands and nothing has been recorded yet. Accrued expenses are expenses that the business has incurred but not yet paid. Expenses that the business has incurred but not yet paid. So they've received the good or the services, they've used up that benefit, but they have not paid any cash yet. Accrued expenses, when we do these adjusting entries, always create a liability. So it'll be some sort of payable that we will set up. So when you do this, the entry is always going to be debit an expense account, some type of expense, and credit some type of liability, some sort of payable. So obviously you need to be more specific when you have a real question. You can't just say expense, you need to say what kind of expense, but you will always debit some type of expense, credit some type of payable. Now we've seen some entries like this in chapter 2 when we were doing journal entries. So the example maybe that we looked at, we received a bill for $800 to be paid later. So in those ones, we debited whatever the expense was, whatever kind of bill it was, and we credited accounts payable. So it's the same idea here, but the reason we often have to do these as an accrual in an adjusting entry is because we haven't received any type of source document or any type of bill yet. So nothing has been booked during that accounting period. But as the accountants, we know that this expense exists and that it's been incurred. So even though we don't have the bill yet, we know we need to do this adjusting entry, this accrual, to record that expense. So a few common ones that you would see for accrued expenses are payroll. So often a pay period doesn't end and get paid exactly at the end of a month. It typically would run over that amount or run over that period end. So we need to accrue that payroll, book the expense related to the month we're talking about. Interest expense on loans is also very common. So the bank, typically you pay interest the following month for the previous month. So that interest expense needs to be accrued. And then any time that you just have a bill that hasn't been received yet. So maybe your utilities bill is late coming in, so it hasn't been recorded during the month, but you know at the month end you need to accrue some sort of expense for that. Okay, so let's look at an example here for salaries. So HEC pays its 2 employees a bi-monthly salary of $4,000 in total. So that means for each or for both of the employees, it pays this $4,000 on the 15th and the last day of the month. The employees are paid on May 15th, but May 31st is a Saturday. So because of that, the employees will wait and they have to receive their paycheck on the Monday when they come into work. So they're not going to get paid until June 2nd. So we know we have this matching principle. We need to match the expenses within the period that they are incurred. So this pay period goes from the 16th to the 31st. We've fully incurred that expense because we've had those employees work for us. So we need to accrue the payroll even though it's not getting paid. We need to record the expenses in May. So our debit here, we're talking about salaries. So we will debit salaries expense. For $4,000. And our credit is to salaries payable. $4,000. So it's really important to note here that we are using this salaries payable account, not just into accounts payable. Salaries is important enough that you want to track that within its own account. So whenever we're talking about salaries and we're accruing something, you need to put it into its own salaries payable account. Don't just lump it in with accounts payable. And the same would go for interest. If you're recording interest on some type of loan, you put that into its own interest payable account. It doesn't go into AP. It doesn't go on top of the loan balance. You'd set up an interest payable account for that. Those are kind of the main ones because they're important. We want to know them, keep them separate. If you were talking about supplies or utilities or something that's repetitive, it's always going to be the same amount, or you're always going to have the same vendor, same type of expenses. Those are the ones that go into accounts payable. But salaries and interest, they need to have their own account. So keep that in mind as you go through more examples. Okay, so we're still going to continue on with this one. We've recorded this accrual. So this is what we would see in our T accounts. So we know that it said in the example they got paid on the 15th. Now they're getting paid, or we're accruing this amount for the 31st. So we know that each month they get paid $8,000, or they incur that amount. So we always need to have that expense in the month for the full amount. Since we haven't paid it, we have $4,000 in this salaries payable account. So it meets the time period assumption and also the matching objective. We're matching this payroll or this salary with the right time period. Okay. So next, let's think about what happens when they actually pay this amount. So June 2nd is the Monday. These employees come into work that day and they actually get their paycheck. So we're going to debit what account? Right, we will debit salaries payable. We set up that payable at the end of May, and now we need to get rid of it because we're paying it off. So we decrease salaries payable through debiting it, and we will credit cash because we're actually giving them their paychecks on this day. So it says here, and this is really important to note, that the payment on this date doesn't impact expenses because this payment is a May expense and we've already recorded the full amount. So instead, we're just getting rid of this salaries payable. We're getting that down to zero because we don't owe them anything anymore. We will now owe them that amount on their next paycheck in June, and we'll book new entries for that. Okay, so ignore those. That's an example of an accrued expense. We're discussing salaries. I've posted another example right below the videos in that practice area, so you can go find the one labeled accrued expenses and try that out. And now we're just going to jump right into accrued revenues. These are defined Oh, sorry. I'm actually just going to wait. I'll make another video for accrued revenues. So you'll find that one in the next video.